The Fed suspended share buybacks and capped dividend payments for banks at current levels in the third quarter. The move came after the central bank's annual bank stress test, which showed that roughly a quarter of banks are likely to breach minimum capital ratios in the case of a double dip recession. Let's bring in Calvin Schnure. He is the senior economist at Nareit. He's also a former economist at the Fed. Calvin, always good to talk to you. There are some Fed governors that have suggested that banks shouldn't be paying out dividends at all at this point. But does this move that we saw yesterday go far enough in ensuring financial stability when you consider the uncertainty that's around the economic recovery right now and just the virus in general?
There's a lot of uncertainty, and that's exactly why the Fed did this move. This is really a precautionary move. It's a prudent move. What they're saying is the banks should retain any source of capital that they have in case the situation ends up a lot worse than expected. Now, the Fed ran three scenarios: a V, a U, and a W. Okay, we're familiar with the alphabet. What is this? A V means by the end of this year, economic activity is kind of back to where it had been. A U means it's a lot slower recovery. That by the end of this year, still not anywhere near back to where it had been. And a W would be a double dip recession. And what the Fed said is under all three of these scenarios, actually most banks would remain well capitalized. There are some banks that would come close to their required minimum capital, but they're not saying that they're really on the ropes. They're saying that they would be undercapitalized, not that they would be in risk of failing. So what specifically did they do? They said you're going to suspend all share buybacks. You can't buy back stock, which pays out money. You're going to limit dividend payments to what net income is. Now, net income is going to be really weak this year because they're provisioning against possible losses and so on. So you can see a lot of dividend cuts. But essentially, this means the bank's going to keep the money in-house. That's eventually going to be there for the shareholders. It's just saying, let's hold on to it and make sure we don't need it in the future.
Kelvin, you just highlighted the multiple scenarios we've been looking at in terms of the economic recovery. What do you think is the most likely? I mean, has the risk to the downside been elevated as a result of the flare-ups that we have been seeing in states in the South as well as the West over the last few weeks?
As an economist, I've got to say this is really a public health question. There have been two main forces driving the economy and the markets lately. And one is, are we reopening? As you see reopening, consumer spending came back pretty strongly. We found it out in May. You're seeing increases in a lot of types of economic activity. But offsetting that is the risk of flare-ups, and we've seen that as well. And the fate in the future really depends on whether the current flare-ups can be brought under control so that we can reopen perhaps in a more measured rate than we had been. I think one thing that a lot of people are confusing is the thing we're either open or closed. This is a dial. There's a long way between 0 and 10 or 11 if you're into that camp. We shouldn't go from 0 to 10 or 11. We should go from 0 to 3, then to 5, then to 7. And that way we might have a lot better chance at reopening without aggravating the spread that could endanger the whole scenario.
And Kelvin, I guess the question is, what is this sort of stop and go scenario, this uncertainty around the virus? What does that do to consumer sentiment? We saw some good numbers today, consumer spending jumping about 8% in May, but that was after a historic low that we saw in April. When you look at how far we have come back from the low, what does that suggest on where the consumer mindset is right now?
Well, we actually also did see a reading on consumer sentiment, and it made a bit of a rebound as well, but it's still quite a bit below where it was before the crisis. And that makes sense because none of us has a really good measure of how this is going to play out. Ultimately, if we look a year or two from now, I think we're going to say, wow, that was a difficult, rocky time, but now we are back to a solid economy. The question is the path from here to there. So this morning's consumer spending numbers for May were good, up 8.1%. They retraced some of the decline. They still have some more to go to get back to where they had been, which is what you'd expect. You'd think that people are going to make the most essential purchases. We saw durable goods spending rise an awful lot. Auto sales rose when you could go back out on the lots. Those are sales people could do quickly. But other things are going to take a lot longer. The hotels, the restaurants and bars, those are going to take a lot longer. We're not going to get back to full speed right away.
And Kelvin, looking through your notes, it sounds like you're pretty optimistic about the recovery, that in other words, that this is going to stay on track? I mean, the question is how quickly things bounce back and how sustainable the levels we're seeing right now are. What's the biggest risk that you think could derail this?
Again, the biggest risk is the health risk, because if you look at the fundamentals, I think it's funny being described as optimistic because I really don't have a great forecast. It's just I'm less pessimistic than the really pessimistic people. So relatively, it is optimistic. And why is that? Well, we still have higher incomes, higher household income, higher personal income than we did before this crisis hit. Now, personal income fell in May, but that was because the stimulus payments were mostly made in April. There were still some made in May, so stimulus payments fell. But one of the most important messages from this morning's consumer spending was also the personal income side. The wage and salary income rose by 2.75% in May. Now that's because people have come back onto the job. So you put together rising wage and salary income and the fact that the stimulus payments have lifted, we actually have more household income so far in this recession than we did prior to it. That means that there's a lot of spending power. There's a lot of potential spending power that's really waiting for the health scene to be clear.
Okay, Kelvin Schnure, the senior economist at Nareit. Thank you so much for joining us today.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.